Hello and welcome to another episode of Full Court Finance here at Zacks. I'm your host, Ben Rains, and today we're looking at three large cap dividend-paying tech stocks for investors to consider buying at the moment amid the renewed market volatility and some coronavirus reopening fears. But before we get into everything, I want to say, remember, if you have any questions or episode suggestions, please feel free to shoot us an email over at podcast@zacks.com. Also, make sure to subscribe and leave a review wherever you listen to your podcasts, and make sure to check out our new zacks.com/promo page for a look at some of our services, portfolios, and more. All right, so before we get into the three dividend-paying large cap tech stocks, I want to quickly review what's going on in the market at the moment, just to give people a better sense of why we're looking at these three stocks. So all three major U.S. indexes suffered some major losses last Thursday, so this past Thursday, after reports of upticks in coronavirus cases started coming as the U.S. economy and the rest of the world slowly emerged from their pandemic lockdowns. So the Dow fell 7%, nearly 7% last Thursday for its worst day since March, while the S&P 500 dipped about 6% and the NASDAQ fell about 5.3%. So some big drop-offs Thursday. And then we had stocks pop a little bit again on Friday to recoup some of those losses. And then again to start this week on Monday, we saw all three major U.S. indexes slip in morning trading. And there seem to be a few basic reasons. As we mentioned, there's the headline reason that Wall Street is worried about the increase of coronavirus cases as U.S. states reopen. And then there were new reports over the weekend that Chinese authorities have shut down parts of Beijing after the capital recorded a number of new coronavirus infections tied to a meat and vegetable market. And then more specifically in the U.S., we have states like Arizona and Texas and Arkansas that are seeing an increased number of cases in the past week as more of these states start to reopen. I live in Chicago, and things are slowly becoming more normalized here as well, where we have restaurants and bars reopening to sit outside. So we'll see how this goes, and you have dozens of states who are all returning to something close to normal. So we'll see if these cases pop up. But the basic sense is that since this virus didn't disappear as states reopened, there was a sense that these cases were going to start to pop back up again because there was no other alternative. It didn't just disappear. So clearly the people in charge of this all who knew we were reopening had to have seen this coming. So maybe these are just some headline driven sell-offs, and more of a reason could be that Wall Street investors are taking their chance at the moment because of these headlines, sort of like a sell the news thing, to take home some profits because we had been on this massive run over the last several months. Just last week, the tech-heavy NASDAQ surged to new highs, and the S&P 500 broke into positive territory for the year. And we still have the S&P 500 up roughly like 35% from its March 23 lows. So we're still up big. So maybe this recent volatility could just be people taking home some profits after this massive run-up. And then we also had some big run-ups after that great May jobs report 2 weeks ago. And then that said, the Fed recently said that they don't see rates going up through at least 2022. They indicated that interest rates could remain near zero through 2022 and at least through the end of next year. This means that investors will have to find returns somewhere. So that could mean stocks will continue to go up as interest rates and stocks go in the opposite direction. And plus, economists said in a recent Wall Street Journal survey from last week that the U.S. economy will likely be in recovery mode by the third quarter, and they're also projecting lower expected unemployment by the end of 2020 than they initially thought just a month ago. So with this all in mind, we're going to take a look at three large cap tech stocks that also pay a dividend that might be worth buying now amid some of this uncertainty, and then also present longer term growth potential. So we're going to start with Verizon. It is the largest U.S. wireless carrier by subscribers. The company topped our Q1 earnings estimates back in late April, and the telecom powerhouse did see its revenue dip slightly, about 1.6%, as the pandemic has impacted its core wireless business. And Verizon also lowered its profit guidance, and pulled its revenue outlook amid all the uncertainty. And they also raised their bad debt reserves to help account for customers who won't be able to pay their bills going forward. So that's all the bad stuff. So despite some of that near-term negativity, Verizon will continue to play a role in the future, which is 5G. And Verizon has also not taken on a ton of bad debt to fuel its expansion into new industries like its rival AT&T. And it was already focused on various cost-cutting measures before the pandemic hit. So that puts the company in a little bit better position. And we also should note that Verizon stock has outpaced its industry. Its average over the last 12 months, and it's up about 17% over the last 2 years. So this tops the S&P 500's 9% move and really looks much better compared to its industry's 8% decline. So up 17% over the last 2 years compared to its broader industry's 8% decline. The company is currently a Zacks Strike number 3 hold that rocks B grades for value and growth in our style score system here at Zacks. And its industry, that's the wireless national industry in our Zacks Industries, rests in the top 32% of our more than 250 Zacks Industries. It also presents, as its value grade would suggest, some solid value. It's trading at about 1.8 times trailing 12-month sales against the S&P 500's 3.4 and its own 12 months high of about 1.9 times sales. And then we should also note, as this is the theme today, Verizon's dividend yield sits at 4.42% at the moment. So this crushes the 10-year U.S. Treasury notes, about 0.68%, and blows away the S&P 500's average of about 1.9%. It does rest farther below AT&T, but that payment is a little skewed because the stock has taken a broader hit than Verizon has. And along with this dividend in its value, the stock rests about 10% off its 52-week highs. So some investors might consider buying it on what we would say is at least a 10% clip from where it has been trading. So a bit of a discount. You could maybe consider it as buying on the dip. So if we look ahead quickly before moving on, our current estimates are calling for the company's overall fiscal year sales to dip about 3.3%. And for its adjusted earnings to dip about 1.4%. So nothing too drastic in terms of what we're calling for as a pullback amid all of this coronavirus downturn. And then if we look ahead, we're calling for its 2021 sales to jump above its 2019 levels, where we're calling for a 3.6% jump above our current year estimate. And then on the bottom line, we're calling for another 3.6% jump above our current year estimate. So near-term setbacks, but longer-term Verizon appears to be a stock that's certainly not going to go anywhere, as it's a telecom powerhouse, and 5G is the near-term future of the broader telecom industry. And now we're going to move on to two stocks that are pretty obvious picks, but that is also obvious at this point amid the uncertainty and volatility is a good thing. So we're going to take a look at Microsoft right now, and it's been a must-own stock for the last several years. It's outpacing all of the other so-called FANG stocks in the past 2 years, and it's only barely lagged Netflix over the last 3-year stretch. So it's been one of the best performing big, large cap tech stocks over the last 3 years. Microsoft's also up about 20% in 2020 to crush the broader tech sector's just 4% climb. And it currently rests about 5% off its recent highs. And the tech giant's run, which has it approaching about a $1.5 trillion market cap, has been driven by its impressive expansion into the cloud computing industry. It's now a leader inside this booming industry alongside Amazon and some others. Last quarter, its intelligent cloud revenue jumped nearly 30% for the second period in a row. And its cloud division, pulled in the most in terms of actual revenue of all three of its units in Q3 of fiscal 2020. But still, despite its big cloud jump, its other two units are still doing well and still growing. Its office-heavy productivity and business process division has continued to grow as well. And we should note that along with its cloud computing business, its Office 365 suite really remains vital to businesses, governments, schools, consumers, and then amid this coronavirus lockdown and the stay-at-home economy, which might see more businesses remain work from home for longer than some people expect, especially in big cities with public transportation being an issue. Its Teams business is tailor-made for that environment, and it's been able to fend off smaller rivals such as Slack and Zoom. And then let's also not forget that its consumer electronics business continues to grow, and it's part of the booming video game industry that's expected to continue to grow for years and years to come. The company is also positioned to weather really any economic storm, given its $137 billion in cash and equivalents that it closed the end of last quarter with. It's also bought back a ton of stock, and it continues to raise its dividend payout with its current 1.1% yield, well above the 10-year U.S. Treasury note, as we just noted. So obviously, this yield is smaller than Verizon, but you've had a massive run for Microsoft stock. So its yield is always going to be a little lower than some of the stocks who have not performed as well over the last several years. So if we look ahead, our Zacks estimates call for its revenue to jump about 12.5% this year. So that's amid all of the coronavirus economic downturn that shows that its cloud computing business is able to grow amid all of this and will likely continue to grow. Because if you can grow during this environment, you'll be able to grow really during anything. And then another 10% that next year, if we look ahead to what is its fiscal 2021. And then meanwhile, its adjusted earnings per share figures are projected to surge 20% this year, and then another 9.5% next year. And Microsoft is currently a Zacks rank number 3 hold at the moment. So obviously, Microsoft, a great stock to own now and for the future, stable amid all of this worries. And then another company that seems all too obvious of a pick, and that's also why it's worth considering amid the uncertainty, is Apple. And it's slowly working its way something close to normal in China. And obviously, any setbacks in China are kind of unknown at this point. And it's also slowly reopening some of its stores in the US and elsewhere. And investors should note, though, that the Wall Street Journal and other outlets have reported that Apple is pushing the production ramp up of its next iPhone because of the setbacks that it's already faced in China and elsewhere. So we'll see what happens with that in the fall when it tends to release its latest iPhones, which they're expecting this. Investors and Wall Street and analysts were expecting this fall's iPhone to be a big jump in the tech within the iPhone. So we'll see what happens with that in the fall. And the firm clearly still does face, as we mentioned, potential setbacks and reduced demand for its high-priced iPhones in the near term, even though there are signs of the economy slowly starting to head in the right direction with those jobless claims trending downwards and people heading back to work. So with that said, Apple's Q2 revenue, if we look back, did top our estimates, and it actually climbed about half a percentage point, so about 0.5%. And it was once again driven by its non-iPhone business, which is a good sign for investors amid what is expected to be a downturn in iPhone sales. So this includes its services and wearables division, with both, which both surged to new quarterly records last quarter, up 17% for services and up 23% by wearables, driven by those wireless AirPod headphones that you see everyone wearing. And we should also note that its adjusted earnings jumped about 4% last quarter, despite all of those setbacks. And then more importantly, during these uncertain times, it closed the quarter with $83 billion in net cash. So that's considering its debt, it has $83 billion in just cash straight up, which will help, like with Microsoft, to really weather any storms and continue to buy back stock, which it also is set to do. It authorized an increase of $50 billion to its current stock buyback program, which is happening as many other companies pull back their stock buyback programs. That's AT&T and other big giants amid all of the coronavirus chaos. And the tech giant also raised its dividend by 6%, and its current yields rest at about just under 1%, so about 0.98%. So about the same yield as Microsoft's offering at the moment. And if we look ahead to the rest of this year, we're calling for its fiscal 2020 revenue to climb about 1%, with its adjusted earnings set to jump about 3.5%. And then if we look ahead to 2021, its earnings consensus has climbed recently, so it's trending in the right direction for 2021, and its actual bottom line is projected to jump about 24% above our current year estimate, with revenues expected to climb about 15% higher than our current year estimate. So small gains this year, and then a big jump is what we're projecting in 2021. And then Apple shares are up about 15% in 2020. And like Microsoft, they hit new highs recently, as you saw the NASDAQ hit new highs just last week. And like all three of the stocks on this list, Apple is currently at Zacks rank number 3 hold at the moment, and it remains, as it has for a long time now, one of the safer plays on Wall Street. So all three of these tech stocks present dividends and the ability to grow in the long term, and might be worth considering now amid all of this uncertainty and renewed coronavirus spikes and lockdown fears that's just going to be in the news for the foreseeable future. So that does it for another episode of Full Court Finance. Until next time, I'm your host, Ben Rains. And remember, if you have any questions or episode suggestions, please feel free to shoot us an email over at podcast@zacks.com.
This material is being provided for informational purposes only, and nothing herein constitutes investment, legal, accounting, or tax advice, or a recommendation to buy, sell, or hold a security. Do not act or rely upon the information and advice given in this podcast without seeking the services of competent and professional legal, tax, or accounting counsel. Publication and distribution of this podcast is not intended to create, and the information contained herein does not constitute an attorney-client relationship. No recommendation or advice is being given as to whether any investment or strategy is suitable for a particular investor. It should not be assumed that any investments in securities, companies, sectors, or markets identified and described were or will be profitable. All information is current as of the date herein and is subject to change without notice. Any views or opinions expressed may not reflect those of Zacks Investment Research as a whole.